I wanted to create something to kind of help, you guys or whoever's watching this, just so you don't have to go through the pitfalls that I went through. The course, to pass the course, you have to take an objective assessment. So you just got to take a test. The test has 69 questions on it. I had to take this test 3 fucking times to pass it. The test is really hard, really hard. But hopefully, after this video, it'll help you to be successful taking the test. So first thing, make sure that before your first attempt for the test, before you take your first attempt, go through the course tips. All right, when you go through the course tips, there's a web seminar by Dr. Such and Such, and he goes through pretty much every topic that's going to be on the test. I think the webinar has like 150 something questions, and I think it's like 2 hours long. I didn't actually do that until after my first attempt because I wasn't aware of it. But and there's also on course tips, there's a study guide that has like 150 questions on it, right? But like I said, I went through the seminar and I went through the 150 questions, and I still failed it the second time because this is the first class that I've ever taken that every fucking thing that we went over was literally on the test. Now, when you go through the coursework, some shit that's important, they kind of go past it really fast, and some shit that's not really that important, they like go in depth in it. So it's like, it's just difficult. So like I said, don't take this course lightly. Like, you got to put in shit, I would say, like a job. You got to probably put in 40 hours a week minimum to really, really, really hone in on everything. Because literally everything that you see, somehow they fucking put everything that you went over, no matter how minuscule, they somehow put it on the damn test. So like I said, first things first, make sure you go through the course tips. Make sure that you feel comfortable with this thing, with your calculator. Mine is a BA2 Plus by Texas Instruments. This thing, without this and knowing how to know the yield to maturity, some of the shit I'm saying if you haven't taken it yet, some of the shit I'm saying may not make sense. You may be like, what are you talking about? But it will. You have to get very intimate with this fucking thing and understand bond pricing. All right, should I invest in bond? Should I not invest inside of a bond? Because out of the 69 questions, I would say probably 10 to 15 is questions about bonds, right? Now, the funny thing was, I thought I was going to be fucked up on the math part, but I wasn't. I wasn't prepared for all the other stuff because the way that they actually formulate the questions is kind of, some of the questions you kind of don't understand what they're asking, right? But like I said, with the course tips, and hopefully when I go through this, because this is a little Quizlet that I made for myself, all the shit that now I'm not going to go through all of it because it's shit 266 questions, but I'm going to go through some of the stuff just to kind of help you guys, right? Because like I said, anytime I took the test or anytime I didn't know something, I would put it inside the Quizlet, and then after I put all the shit together, I finally passed it on my third attempt. Now, was another thing I wasn't aware of. I failed it twice. On the third attempt, you have to pay for the third attempt. It's only right, I guess. And I think it was $60 that I had to pay. When you actually take the test as well, the test is proctored, right? So they watch everything that you do to make sure that you don't cheat or do nothing weird. But like I said, in summary, go through the course tips a bunch of times. I think I watched the seminar or the webinar probably twice, and it's like two hours long. What's the other thing I said? Go through the study guide that's in course tips. And another thing, after each section in the actual coursework, there is a post assessment. The post assessments at the end of each section is going to be very vital, and that's what's going to help you on the test. The only thing about that shit, though, seems like the stuff that's in the post assessments is a little bit harder than what's on the actual test. And last but not least, the pre-assessment is fucking trash. It's trash. It's not going to help you at all. I passed that shit with flying colors, and it gave me false confidence, right? I thought, yeah, I'm about to knock this out. I'm going to be finished. Not at all. The pre-assessment is more like, I don't know what the fuck the pre-assessment is for. Because like I said, the pre-assessment is nothing like the real assessment. All right? Anyway, Let's go through some of this stuff just to kind of give you a well-rounded, okay, this is kind of some of the stuff that's going to be on the test. Because like I said, it's math stuff and a lot of other topics, all right? So, is this true or false? Secondary markets are where securities are initially offered to the public. Is that true or is that false? We already know that that is false. The first place where things are offered is the auction market, okay? So next up, accounts payable represents money a firm owes to who? Great, fantastic. So accounts payable represents money a firm owes to suppliers for shit that they bought on credit. All right. So another thing, like I said, some of this stuff may not make sense. Another thing you have to fully understand is a statement of cash flows. Statement of cash flows. You have to understand what's an investing activity. So on as already, what's an investing activity? What's an operating activity? You have to really, really, really be good at that. Okay. Next up. The matching principle in accrual accounting requires that what? It requires that revenues are matched to expenses incurred to generate the revenues. All right, gang, so some of this shit I don't remember the answer to because I finished up a couple weeks ago and I'm in my next class. So some of this shit I got a brain dump, but it's coming back to me as I'm talking to y'all. All right, the evolution of retained earnings is best described by what? So retained earnings is the money that you have left over, or the money that you actually retain within inside the company that you have to pay out as dividends. All right, it's best represented by net income minus dividends. All right. Next up, net fixed assets represents what? That's another thing. You have to understand what are net fixed assets, what are current assets. What are current liabilities? What are long-term liabilities? All right, so current liabilities and current assets is anything that you have to fuck with inside the next 12 months. All right, so if it's something that you have to pay in the next 12 months, it will be a liability. If it's something that's going to give you money in the next 12 months, it's going to be a current asset. So current assets is stuff that you have to worry about in the next 12 months as well as current liabilities. The income statement represents a snapshot of the firm at one point in time. Is that true or false? Another thing, you have to understand the difference between the income statement and the balance sheet. What is the balance sheet used for? What is the income statement used for? Man, I should be getting a check from WGUs for this shit, but I'm doing it for the love. All right, so what is that? Is this true or false? It is not true. So the income statement represents the results of operations over a period of time. All right, another thing that I had to drill in my head. The income statement is a period in time. The balance sheet is a point in time. So the income sheet, this is what we did from July to October. The balance sheet this is where we're at right now, a point in time. Point in time for balance sheet, period of time for income statement. All right, free cash flow is different from cash flows from operations because free cash flow is what? What is free cash flow? What is that? All right, it represents cash flow after required investment. So after you buy your other products, after you do whatever you need to do, that is your free cash flow after you actually reinvest inside of the company. What's something that's not part of the Sarbanes-Oxley Act? This is another thing. The Federal Reserve Act, the Sarbanes-Oxley Act, shit, what's the other one? Like I told you, it's been a couple of weeks, so we're gonna go through it. But all of the acts, you have to understand who came up with it, what was it for, what you could and you cannot do. All right. Like what is the Financial Stability Oversight Board? What part of that? You know, what was a part of that? So on and so forth. So you have to just make sure that all the little acts that come up, because at the end, I think it's like the last chapter, the last section. It doesn't seem like, oh, this probably ain't really be on the test that much, but it is. It's on there a lot. So assigning specific accounting firms to audit a firm based on its industry is not a part of the Sarbanes-Oxley Act. All firms that wish to make an initial public offering of equity or debt for non-accredited investors must first file public disclosure data with the SEC. That's just, some of this stuff isn't questions, it's just facts. That is a fact. You have to do that. Which of the following acts was like this, all right? Which of the following acts was instituted in an effort to prevent bank runs? Shit. I want to say this is the Federal Reserve Act of 1913, I think. Shit, maybe. I don't know. Like I said, it's been a couple weeks. Let's see. Ooh. So, stuff like this, you have to understand what it was for, so on and so forth. The years don't matter. That's one thing I was worried about, but the year, it never asked you, like, what year it came out or nothing like that, okay? Which of the following committees, this is another one, which of the following committees was created as a direct result of the Dodd-Frank Act? The Dodd-Frank Act. So, the Dodd-Frank Act created the Financial Oversight Stability Council Board or some shit like that. Let me see. Yes. So this is pretty much to make sure that people are doing what they need to do. Which of the following acts, so I set this up good, so I guess all the acts I put together. Which of the following acts limited types of products a consumer bank could offer or hold, creating a wall between commercial banks and investment banks? Shit, what is this? I think this is the Glass-Steagall Act. Oh, so Glass-Steagall Banking Act of 1933 limited the type of shit that banks could actually offer. Next up, which of the following acts loosened the regulation on types of products financial institutions could offer? The Garmin-St. Act or some shit like that. Let's say Garn-St. Act of 1982 loosened the regulation on types of products financial institutions could offer. Now, I'm recalling this from memory, right? You have to, like I said, I took this a couple weeks ago, and a lot, you know how it is. After you get finished with something, you brain dump a lot of shit, but you have to get really familiar with it. You have to get really familiar with it. Honestly, this took me shit. I started in, I'll be done with my MBA in July. This took me, shit, I think I started in August, and I just got done a couple weeks ago. So, because this I kind of actually, you know, went over, so I'm kind of in the time crunch to finish the other classes, but, yeah, anyway, you don't give a damn about that. FINRA is a private organization overseen by the SEC. That is true, okay? So, FINRA, they have questions like, FINRA is a government organization, blah, blah, but it's not. Because that's the one thing I was messing up on. For some reason, for FINRA, I was always thinking that the F stood for federal, but it actually stands for financial, all right? GAAP, accounting standards allow for significant managerial discretion in reported financial statements. Yes, it does. So all of the stuff that all the stuff that you're seeing, right? All this shit was on the test. We're only 17 questions in. I'll probably go up to 50 or 60, just like I said, just to give you a well-rounded, like, okay, because like I said, I felt so confident going in there. The pre-assessment, once again, just do it, take it, just to take it, you know, but it's no bueno. All right, suppose the inventory turnover of a company is higher than the industry. Based on this observation, which of the following is most likely? Inventory turnover is how much you sell out of shit. So I sell out of stuff and then recoup. Sell out of shit and then get some more. Sell out of shit and then re-up, right? So I sell donuts. I sell 100 donuts. I make 100 more donuts. I sell a lot of donuts. I sell a lot of more donuts. So if you have high inventory turnover, that means that you selling out of shit so fast that you can't keep up with demand. All right. Bam, I was right. The firm has too little inventory, resulting in loss of sales or stock out. So basically, you come to the bakery, I'm a baker, and I say, hey man, shit, you know, I ain't got none. I'm sold out, all right? So high inventory turnover. Which one of the following is not a characteristic of ordinary annuities? Ordinary annuities don't pay out what they're supposed to pay out at the beginning of every period. Payments are made at the beginning of each period is not a characteristic of ordinary annuities. What type of bond is tax exempt? And like I said, there's a lot of questions about bonds. If you don't know shit, you need to know about bonds. And another thing, make sure that you're well-rounded. Like I said, you need to know everything. I know that's sound crazy, but it's true. You need to know everything because everything comes up. And if it's a bunch of, and if question 1, 2, 3, you don't know, it's gonna fuck up your confidence. So the stuff that you do know, you'll start second guessing yourself. So just make sure that you're really well-rounded, all right? And like I said, learn from my mistakes. Don't fucking have to take the test 3 damn times. My mentor was trying to like make me feel better, like everybody fails it, or you know, everybody, you know, this is the hardest class. Because he told me that before. I was like, yeah, okay, whatever. Because I was, you know, I was rocking out everything else, but this shit, it was very difficult. So if you do fail, no big deal. Double back and you'll be okay. Do not get discouraged. Why are bonds the primary method for raising capital? Because they remove the intermediary, such as like banks. The amount repaid at the expiration date is called what? So the amount repaid at the expiration date of a bond is called what? It's called the par value. The par value. Okay, so I'm not going to go through this because if it's your first time looking at this, you won't understand what I'm talking about anyway. But this right here is what I'm talking about, and this is where your time value of money, which is another term that you may not be familiar with, but this is where your calculator comes in, okay? So using this right here, you can actually figure out if a bond is worth what they're actually selling it for. All right, so with this, it says you buy $1,000 face value bond. So for, oh shit. Okay, everything's good. All right, so for this, you would put $1,000 for FV. You will put $700 for PV, because that's the present value. Then it says 10 years to maturity. Since it's paying semi-annual, right? Semi-annual, you have to actually times that by 2. So instead of being 10 years to maturity, it's going to be 20 years to maturity. So you will put 20 for N, which pays at 5% coupon. So the coupon rate goes inside of the payment, all right? How do you figure out the payment? You have to do 5%, excuse me, 5% times 1,000, which is the primary value, divided by 2 because it's a semi-annual, all right? And then what you're actually solving for is IY, which is the interest rate. Now, if all of the shit I said don't make no sense, you probably haven't went through the course yet, or haven't got to this section yet. But once you get to this course, it's gonna, oh shit, this makes perfect sense. And another thing is, when you're going through the coursework, when you get to this bond part, it seems daunting at first, but after you keep on putting in the reps, you'll be fine. Just like I said, I ain't did this shit in weeks, and I'm not no math guy. I don't really enjoy math, but once you get this shit, you'll get it. You just got to put the reps in. So after you press IY, it's 9.77%. So that would be lower than the required return, which was 10%. This is one of the same ones, so I can go through these. Another thing, you have to understand APR and APY. So the rate and the yield, those are two things. So the math stuff, I'm not gonna go too deep into it, just because, I mean, the only way you can get that is the reps. What is the interest rate for annual payments of the bond known as? That's called the coupon rate. So the interest rate for a bond is called the coupon rate. This is another one, another math. Okay, what type of bond can be traded in for stock? This is the easy one to remember. It's a convertible, what the fuck? Okay, that's, okay, I don't know why that is convertible bonds. All right, so you can convert a bond into a stock. It's a convertible bond. I don't know why the hell I just put bond. Okay, it's another math thing. Another thing, a lot of these things on the actual test, the what's the word? The formula is given to you on the test. All right, you just have to understand what the question is asking for and when to actually use the formula, okay? Common stock gives shareholders the right to vote on company matters. There's two different types of stock. So you got common stock and preferred stock. Preferred stock sounds like it would give you rights to vote, but it doesn't. Common stock does that. But preferred stock allows you, if the people go bankrupt or something like that, it allows you first dibs on payment. So if they go bankruptcy or they go, they liquidate it, it gives you first dibs on getting paid. New startup ventures often issue preferred stock. That's true. Where is that? That stuff. And you see, I'm going by the slides, but you see how many math questions I got in. This is the shit I made for myself, just to, and like I said, it's 200. I did 266 of these. You got to put in the reps. Have to. Like, I'm not gonna lie. The other, courses that I went through, I kind of was finessing it. I'm just like, okay, because the shit was okay. It was, not easy, but it was okay. It was pretty straightforward. This shit, not so much. Which of the following is a typical characteristic of a preferred stock? I gave you one of them already. So dividends and heirs, cumulative dividends, a higher payoff claim in the case of bankruptcy. Then some other math stuff. So this right here, you're trying to figure out what the return is if the company is inside a recession or if they're expanding. All right, I'm not gonna go through this because, like I said, this stuff you just got to put in the reps, man. And a CAPM framework, why do investors hold the market portfolio? Because the higher expected returns relative to risk, it's more likely that you're going to converge to the market portfolio. More math stuff. Like I said, gang, make sure that you go hard on this stuff. If a firm has more idiosyncratic risks than according to CAPM, the return required by shareholders will be higher. Is that true or false? That is false because CAPM thinks that you can actually, what's it called? You can diversify any kind of risk. So CAPM, fuck it, you can diversify, split your stuff out, and it'll get rid of the risk. So that would be false. More math stuff. If market interest rates increase, then a firm's cost of capital will likely increase. Is that true or false? That's true. Okay, I'm at 54, but I'm still gonna keep going because I kind of skipped through a bunch of the math shit. So accounts that vary directly with sales are called what? They're called spontaneous accounts. Spontaneous accounts. Which of the following is usually not a spontaneous account? Long-term debt is not long-term debt is not a spontaneous account. Like I said, gang, you have to get like I am. Like I said, this was weeks ago. I don't even know how the fuck I'm remembering this shit, but it gotta be drilled in. So when it's go time to take the test, it's too easy for you. What is dividends divided by net income called? I think it's called the dividend payout ratio. Ooh. All right, how do we compute future levels of spontaneous accounts? This shit, I don't know. How do we compute future levels of spontaneous accounts? I think you have to multiply, you have to multiply projected level of sales by historical percent of sales. That's how you figure out the future levels of spontaneous accounts. The depreciable, you know what the hell I'm trying to say, asset in the initial outlay calculation is the, to get the depreciable asset, you have to, I think it's the original cost of the equipment plus shipping and installation. Purchase price of the new asset plus shipping and installation costs. Perfect. One of the strengths of the payback method is that the cutoff is subjective. No, that's actually one of the weaknesses. Good news is, I don't remember seeing this shit on the test at all. I don't remember seeing the payback method on the test at all, so I won't worry about it. Initial outlay for a capital project is calculated as, oh, this is another thing, gang. So on the actual exam, the ratios and the formulas are on the exam, but most of them have acronyms, right? So if you don't know what the fuck the acronyms stand for, the formula is kind of a waste. So this right here, to get the initial outlay, how much it's going to cost for you to do what you need to do, is the purchase price of the asset plus shipping and installation plus investment in working capital. Working capital is what WC is, minus net proceeds from the sale of the old asset. No, we ain't gonna worry with that. For capital budgeting analysis, the relevant cash flows from a new project are called interval cash flows, incremental cash flows, incremental cash flows. I ain't gonna worry with that. Oh, this is another thing. On the exam, this came up the degree of combined leverage, degree of financial leverage, degree of operating leverage, right? So the degree of financial leverage is how dependent is a business on debt. All right. So how dependent are we? How much loans do we have? So on and so forth. How much credit do we have? The degree of operating risk is how risky and how risky the actual business is. Like, how good are we on operations? Or can we pay our bills today and tomorrow? So on and so forth. Okay. So operating leverage, financial leverage, and combined leverage is both of them. As corporate tax rates increase, the firm experiences a higher tax shield from interest. That's true. Debt covenants and restrictions help to ensure management is meeting bond and shareholder expectations. That's true as well. On an income statement, interest payments are deducted before taxes are calculated. That's true as well. A working capital increase caused by an increase in inventory will be a cash inflow for the firm. All right. Another thing, you have to be really, like when I was saying, investing activities, financing activities, operating activities, you have to understand what's an inflow of cash and what's an outflow of cash. All right. So make sure that you feel comfortable with that as well. A collection float can be specifically defined as the time it takes for a firm to be able to use the payments from customers. That is true. Sometimes the amount of the reserve balance is determined by the bank from which the firm has obtained capital. Yeah, that's true too. Yeah, if I ain't got none, that's true. Okay, good. A commonly used method for shortening the float time is electronic check processing. That is true. All this shit is coming back. A discount policy. Okay, great. So this came up a couple of times on the test. Whenever you see this, right? Like I said, it says a discount policy of 2/10 net 30 means that a discount of 2% is applied if payment is received within 10 days and that the total bill is due in 60 days. Let's say that it said 10 net 60. That would mean that you would get a 10% discount if you paid the you would get a 10% discount if you paid the entire amount 10 days before the 60 days was up. All right. So just the first number is a discount. The second number is how many days before the end of the pay period. And then the last number is the entire length. All right. So 2%, 10 days, 30 days. That's the whole payment total process. What is the equation for free cash flow to the firm? That's what FCFF stands for. That's like I said, a lot of the acronyms, you have to understand what they stand for, is you're going to be fucked. So that is EBIT. This is what I was talking about, gang. Like if this shit was on the, because a couple times on the exam, I would forget what shit stood for, so on and so forth. So the ratio was kind of useless, honestly. So EBIT, right? EBIT is operating income. All right, that's all EBIT is. EBIT, operating income, same thing. Plus depreciation minus CapEx. Now, what the fuck is CapEx? CapEx is capital expenditures, and then increase in working capital. All right. Holy moly, shit is bringing back nightmares, man. What is the name of the reciprocal of the PE ratio, or prices and earning ratio, flipped upside down? EP called. Their earnings yield. Okay, I'm gonna do a few more because I think I done gave you enough game, just to feel a little bit more comfortable. DCF typically is best suited for established firms for which forecasting is fairly reliable. DCF. Discounted cash flow? Yeah, discounted cash flow. Discounted cash flow. The last flow in the DCF approach, which typically uses a model such as the Gordon Growth model, that's another thing. You have to know the difference between the Gordon Growth model, the CAPM model, what the strengths and the weaknesses are of both. To estimate all of the future cash flows beyond a certain point is called terminal cash flow. Terminal value. Terminal is always at the end. The goal of using a financial derivative such as a future or such as a forward or a future is to not make any money off of market changes or some shit. Make no profits through exchange rate movements. Oh, another thing that fucking sucks. If you've never taken a test through WGU that's proctored, you see how I'm talking myself through it. You can't fucking talk, or you can't talk as loud as I am, right? You have to be really like damn near low to where if somebody was, a couple inches away from you, they wouldn't be able to hear you. So just remember that it's proctored. They're looking at you, and the reason that they do that is because I'm guessing in the past somebody probably was reading out the fucking questions and recording it or something just so they could take it again. I don't know. Okay, what is the primary motive of tariffs? This is another thing. Since businesses do business globally most of the time, you have to figure out what's the implications if you import some shit from somewhere else or if you export stuff. So the primary motive of tariffs is to protect domestic industries. Can't talk. Because tariffs, are just pretty much taxes on shit that comes in. All right. The purpose of currency restriction is what? Is to prevent the amount of money that a business can take out of its own country. The basic balance sheet equation states that assets are equal to liabilities plus owner's equity. This is because all assets are, and just like I said, the way these questions are structured, of course, this isn't fucking questions from the actual assessment because, like I said, it was proctored. There's no way. And then you get a whiteboard. You get a whiteboard to do your equations, and then you need to write anything down. But you got to erase that when you get done. Financed by other people's money or by the firm's owner's money. Okay, I'm going to tap out in a minute because I'm fucking starving, but a few more. Accrual accounting is superior for understanding the operations of a firm. The cash accounting system may lead you to an inaccurate view of the firm since the receipt and disbursement of cash is frequently not synchronized with operating variables. So, accrual accounting, the way that I remember it is that soon as this shit happened, you put it on your balance sheet, right? With accrual accounting, let's say that I get somebody's supposed to pay me $500,000. I get $300,000 today, and they'll give me $200,000 last month. What should I put on the balance sheet? You should put $500,000 for revenue, not $300,000. All right, you pretty much say, okay, he gave me $300,000, so I guess he's gonna give me the other two, right? Okay, makes sense. So accrual accounting, the way I remember it is, as soon as the shit happens, the shit happens. You put it down. All right. Which of the following would not be considered an operating expense? This is another thing. Understanding operating expenses. What's the other thing? Operating expenses. are operating activities. Operating activities, financing activities, and investing activities. All right. So operating activities are pretty much all your current stuff. All right. Financing activities have to do with long-term liabilities, and investing activities have to do with long-term assets. Oh shit! Let me go back. I want to say this is interest expense. Yep. The evolution of, we already talked about that. We already said that. We talked about that. The income statement may help you understand firm operations, but net income does not necessarily show cash to the company. That's true. We already talked about that. The use of the historical cost principle on the balance sheet means that you use the original cost of the equipment minus depreciation. Yeah. That most assets are stated at the original cost minus depreciation. The basic income statement equation is revenues minus expenses. That's how you get net income. Another thing, when I was saying that the formulas are given to you on the actual exam, they're given to you, but sometimes the way that there's like you have to know the formula within inside the formula. So let's say that some shit says, you know, you got to do EBIT plus working capital minus something else. EBIT is operating income expenses, subtracting operating income from gross profit. So your operating income minus your revenues or your profit gives you EBIT. But if you don't know that, and the formula says EBIT plus something else, you're already fucked because you don't even know how to get the EBIT. All right? I'm glad that I told you guys that before I tapped off. Okay, current assets. At the top of the asset side of the balance sheet, we see current assets. Current assets are cash or assets that will be converted into cash within the next year. They are listed in order of liquidity. Something I said earlier. Operating activities are current assets except cash. All right? Operating activities are not cash. All right? Fixed assets. Fixed assets provide a benefit to a firm for more than a year. Remember, this shit, current assets, is anything under a year or within a year. Everything else, fixed assets, long-term liabilities, everything over a year. Fixed assets provide a benefit to the firm for more than 1 year and are usually recorded on the balance sheet at historical costs. True or false? Inventory is the most liquid component of current assets. False as fuck. Inventory is probably the least liquid. Of the major components comprising current assets, cash, marketable securities, accounts receivable, and inventory is usually the least liquid. So I'm 104 questions in. Baby glad I love you guys. All right, current liabilities. Current liabilities are obligations that require cash in the next year and are usually listed in order of maturity from shortest to longest. That's true. Notes payable. So another thing, you have to know the difference between accounts payable and notes payable. All right, notes payable involves an explicit interest-bearing arrangement with the lender. Accounts payable does not. Current liabilities are reported in the order of maturity. We just talked about that. There are only two things a company can do with its net income. You can either pay it out as dividends or retain it within inside the company. So this is something that you need to be really familiar with, right? So there's going to be some questions on there, and it's going to be like, okay, this is what's going on. What is your cash flows from whatever? So this one right here is asking you, what is your cash flows from financing? This right here is something that I struggle with, and my mentor said a lot of other people struggle with. Because some of the shit just seemed like it kind of runs together, right? So for this, they want to know cash flow from financing. So accounts payable is current. Notes payable is long-term liabilities. So that is a cash flow from financing. Let me make sure I'm telling you this right. Yeah, right. All right, so change in notes payable, because notes payable is a financing activity. Change in long-term debt, because long-term debt is a financing activity. That's the whole thing. You'll be able to figure it out easily if you understand what the actual activities are. Okay, this is because I had to sit down and drill that shit into my head. Okay, if I do this, this, and that, that's a financing. If I do this, it's investing. Most of the time, investing is anything that has to do with PPE, which is property, plant, and equipment. So just remember, if you have to get yourself a system. Okay, operating activities is shit that I got to do within 12 months. Investing is PPE. Financing is long-term liabilities, and then you'll be okay. Like I said, I wish I had this fucking video when I took the test. In order to understand the health of a company, you must understand how the firm generates and expends cash. The impacts of accrual accounting are seen most in relation to net income. True. CFI, or cash, that's another thing. Even that might fuck somebody up. CFI is investing, cash flow from investing. Accounts are generally non-current assets, i.e. bottom of the asset side of the balance sheet. So PPE, so property, plant, equipment is the big ass building that you're in. Let's say that we fucking let's say Tesla, right? So Tesla's building or factory, plus all the machinery that they have in here. They're not expecting the fucking machinery to break in a year, so they pretty much expect the machinery to last damn near as long as the building does, right? All right, well, calculating cash flow from operations, which is CFO, an increase in operating liabilities such as accounts payable or accrued wages represent an inflow to the firm. Yep. Which of the following items should not be included in the calculation of cash flow from financing? Let's think about this. Shit. Should not be calculated. I want to say change in retained earnings. Because common stock, I think, yeah, common stock is financing shit. So selling stock is a financing activity. Paying dividends is a financing activity. And like we said, long-term debt is a financing activity. Let me end on a high note. CFO can be dramatically impacted by managerial discretion in the financial reporting process. True. CFI, this is how you calculate it. Yeah, this is where I'm going to end it at because this is a fucking gem. I just thought about it. The formulas for cash flows is not on the fucking test. It was easy. I didn't have to remember the formulas because I had drilled what the activities were. So I would just boom, boom, boom. I knew what to subtract. I knew what to add, so on and so forth. But to make it easier on you, you can figure out or remember the formulas because the formulas will not be provided to you on the exam. So the formula for cash flow from investing is change in property, plants, and equipment. That's another thing. PPE. It's usually just spelled out as PPE, but if it says acquiring a building or acquiring other shit, you know, for long-term use, then that would be PPE. Plus the depreciation expense is cash flow from investing. All right, so CFI involves any cash in or out of the company due to investment in or disposal of fixed assets. As noted previously, we're simplifying. We didn't know that previously. Our CFF, or cash flow from financing, is the net cash impact from financing and includes cash flows from resorting, increased borrowing, debt repayment, stock issuance, stock repurchase, or dividend payment. So free cash flows is where we're going to end it. Free cash flows is distributable cash. So after you invest whatever you need to invest, it's the cash that you have left over. All right, gang. So in summary, you can rock through this video, go through the fucking course tips, go through that seminar, that webinar. There is a 150 question fucking Word document that you can print out. Go through that, and go back through the post assessments. Once you actually go back through the post assessments, and I would recommend actually not moving forward to your next section until you can actually pass the post assessments at the end of the course, at the end of each section. Not you don't have to get a fucking 100, but at least get 70% or higher, right? Just so you can have because you got to know the shit anyway, because it's kind of like, oh, I can just go to the, no, you have to know everything anyway. All right, gang. So I hope that this video helps you. If you appreciate this, leave a comment below with any other tips that would help out anybody else. Make sure that you like and subscribe. And other than that, have a good day.